Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 6th of April 2020, and yesterday we published a video entitled No Comex Gold. Really? Where we highlighted a Reuters report showing that the Comex, whilst maybe short of gold temporarily, has instituted measures to ensure that it does not run out completely. Now this video attracted a lot of attention, but also a number of detractors. That is understandable, because let's be honest, all of us in the gold and silver stacking community genuinely want to believe that the Comex is running out, and this will in some way cause the price to skyrocket, so our holdings of gold and silver will reward us with a vast fortune, and anything or anyone who may suggest that this will not happen or may not happen, both disappoints and annoys us to the core. Also, we are aware that a number of pumpers follow our channel. We know this because whenever we bring out a video critical to their message, one of their bunch then produces a video dealing with that same subject, but in an opposing direction. But of course not naming us. After all, we should not be given any credibility within their space. God forbid. Well, today's subject is going to upset a few more. Yes, it will upset quite a few people. In fact, as it's on a subject akin to yesterday's video. Can the Comex default or go under? Well, we're going to highlight a number of reasons why this is either extremely unlikely or virtually impossible. And if you're a pumper listening, by all means produce a video contradicting us and have the guts to name us and say why we are wrong. But instead of giving you our views, just in case some of you think we are government shills or anti the precious metal fraternity, rest assured if we were, we would now have hundreds of thousands of subscribers, even if we had to pay to get them. Otherwise the message would not reach enough people to make this all worthwhile. We're going to quote the views of other people, views which incidentally we fully support. So let's listen to our first authoritative source on this subject. Gold Republic article, The Comex Will Not Go Bankrupt. September 21st, 2015. There is a lot of nonsense being written about the gold market. One myth is persistent. The Comex, London's paper gold market, is thought to be on the brink of collapse. For example, Zero Hedge, in one of their articles, stated that, quote, there is now an unprecedented 228 ounces of paper claims, unquote, futures contracts, in circulation for every troy ounce of physical gold in the Comex vaults. Myth or reality? The myth. They call it a crime, a fraudulent gold market. The so-called paper gold market in London is rigged. The largest gold exchange in the world also has gold in its vaults and issues paper certificates. Every buyer on the Comex is a complete fool, and as soon as he finally realizes that he doesn't actually own gold, he will panic and buy physical gold elsewhere. What are the consequences? The gold price will skyrocket, and this will mark the end of an era of gold price manipulation. Those who defend this myth will argue that investing in gold makes no sense as long as the gold market is manipulated. What's really going on? Well, first of all, it's important to understand that the Comex, the gold futures exchange, doesn't own or store gold itself. The traders trading on the Comex do hold gold. In many cases, they trade through a bank that has a commodities division and a dealing desk. In other words, the Comex doesn't hold any gold, nor do major banks in principle. It is the customers of major banks who store their gold with these banks. They have access to the gold, and they make the decisions. There's also a difference between eligible and registered gold. The claim that Comex's vaults are getting empty is based on statistics published about registered gold. Converting gold to actual registered stock will only take a couple of seconds. You'll need only one press on a button to register gold. Beyond that, nothing changes. It's ironic that when we look at how much registered and eligible gold is held by Comex traders, we can see that the ratio of outstanding futures to stored gold has only become smaller and smaller over the years. Furthermore, it is important to understand that futures contracts are not certificates or warehouse receipts. A futures contract is an agreement between two parties about a future delivery of gold at a certain price. Only a small portion of outstanding futures will actually be delivered at any time. In practice, only 2 to 4% of futures contracts actually lead to a delivery of physical gold. So how does it actually work? Someone who is short on a gold future sells a promise to deliver gold at an agreed price at a later point in time. He has two options. He owns gold which is held by a Comex approved depository. If this is the case, there is no default risk. It doesn't matter whether the gold is eligible or registered. In this case, the most common option to exit the short position is an exchange for physical, meaning the physical gold is exchanged for a futures contract and money. He doesn't own gold held at a Comex approved depository. In this case, there are multiple alternatives. He can offset his own contract before the term expires. He can postpone delivery by rolling over his futures contract. And he can postpone delivery by leasing physical gold from another party, enabling him to deliver it. The lease can be settled later, either with cash or physical gold. In sum, the gold market is a futures market. Futures contracts are agreements between two parties about a future delivery of gold. Gold held by Comex approved holding depositories can be converted from eligible to registered easily. Only a small portion of the outstanding futures contracts is close to the delivery date, and there is more than enough gold available in the vaults, either eligible or registered, to execute these deliveries. Physical deliveries can be prevented in several ways. Regarding the alleged shortages, just about every month I'm bombarded with another article arguing that coin and bullion traders have large shortages, and this should somehow show us that gold price is being manipulated. After all, we're running out of gold or silver, and yet the price hasn't changed. There's a mistake in this logic. The shortage of one specific product, take for example the Australian silver koala coin, is interpreted as a more general shortage in the entire precious metals market. It's very well possible that there's a shortage of koala coins. Its producer, Perth Mint, has limited capacity to mint koalas from silver, so it's possible that there are no longer any koalas in stock at a certain point in time. But that doesn't mean there's a shortage of silver. It only means that the production capacity of the Perth Mint is lagging behind the demand for this specific product. More so, Perth Mint does have plenty of ways to acquire silver bullion. It just isn't minting fast enough to keep up with the demand for koalas. This shortage results in a premium on koala coins compared to the silver spot price. And what is true for koalas also goes for other gold and silver coins, as well as smaller bar sizes. Only when there's a shortage of silver bullion arises, the standard size bars they sell on the London Exchange, will it have an impact on the price in the futures market. Until we see that the prices of bullion rise, we do not need to worry about a shortage. I can assure you that there are currently no bullion shortages, and as a result, no price premiums have to be paid for precious metals. Why all the commotion? Often, there are other interests at stake. A lot of people who choose to scare others with horror stories have a commercial interest to do so. Marketing specialists know that a sense of urgency sells well. An example can be drawn from Booking.com. They offer hotel rooms, and when you scan their website looking at rooms, they will notify you with messages expressing urgency. There's one room left. 15 people are looking at this hotel. Last booking 11 minutes ago, etc. The Comex myth is abused to function as an equivalent of Booking.com's now or never marketing tactic. End of article. So the author of this, Olav Dirkmaat, very neatly explains how the Comex works in relation to gold and silver futures. Now you may ask, why have we quoted an article from 2015? Well, we could have done the same 5 or more years previous too. You see, this gold and silver shortage panic and Comex going bust or dollar going under is a regular event, usually spanned out about every 5 years and then allowed to ferment, in the hope that people forget about the last panic, which led nowhere. Let us now look at another article which we thought was very well written, to be fair, by Small Gold, also produced in 2015, because this was when the subject was last most topical, particularly because this was the time that the pumpers, having seen gold and silver prices plummet from their 2011 highs, saw some upward movement in precious metals and began publicizing these arguments in order to gather pace. So here is the article. It's a little long for our normal YouTube channel, but please bear with it. It is an education in itself. Small Gold article, dated 6th of October 2015. Why Comex won't default. 4 reasons Comex won't default or collapse. 1. Comex is not a place to buy gold or silver. It is a paper market. The participants. Comex is a place where traders trade gold and silver they don't have to other traders who don't want it. They are looking for price exposure to gold and silver, not physical bullion. Many of these traders are the bullion banks themselves. In addition, gold and silver bullion dealers often sell their newly purchased inventory short on Comex to hedge their purchases. The greater the volume of silver and gold the bullion dealers sell, the greater number of short contracts they have to sell on Comex to hedge their inventory. Most long and short gold and silver contracts are rolled over or expire by their own terms. Relatively little gold and silver is actually delivered pursuant to Comex contracts. The chart below illustrates the paper nature of Comex versus a physical gold exchange, like the Shanghai Gold Exchange. And here we can see during a 2-week period ended September 25th, 2015, the Shanghai Gold Exchange delivered more gold than Comex delivered during the entire calendar year of 2014. The contracts. Comex gold contracts are denominated in 100 troy-ounce increments. For gold to become eligible to be traded and registered for delivery, it must be of at least 0.995 fineness and be in the form of either 100 troy-ounce bars or 1 kilo bars. Comex silver contracts are available in 5,000 ounce and mini 1,000 ounce form. The 5,000 ounce silver contract may be settled by delivery, but the 1,000 ounce does not allow for delivery unless aggregated with 4 other mini silver contracts. Buy a Comex approved silver bar 1,000 ounce. Anyone serious about acquiring physical metals doesn't trade Comex contracts with an expectation of taking delivery. People looking to acquire physical metals have countless options, including buying and arranging storage from many of the bullion dealers featured on this website. Since the bulk of traders on Comex are using the exchange to hedge their bullion positions or to speculate on price and are not generally not interested in taking physical possession, it doesn't matter if there are only 160,000 ounces of gold registered for delivery. Once the traders accept that there is not a one-to-one correspondence of metals underlying their contracts, it doesn't matter if there are 2, 20, 200 or 2,000 claims per ounce. 2. Today's traders and society accept fractional reserve everything. You are thinking of this place all wrong, as if I had money back in the safe. The money is not here. Watch as good bankster George Bailey in 1946's It's a Wonderful Life convinces his depositors to have faith in fractional reserve banking. The depositor's money not being in the bank isn't viewed as criminal, but rather how banking works. The episode indicates how many people can suspend belief and accept that their money is in the bank when it clearly isn't. It shows how $1 can serve as $10. By analogy, 1 ounce of gold on Comex can serve as 10 ounces, 100 ounces, or even 1,000 ounces of gold, if the traders believe it. This suspension of reality doesn't seem to disturb the vast majority of 20th and 21st century people, other than a select few like Tom in It's a Wonderful Life, and Kylie Bass, who, as a fiduciary, famously took delivery of his client's gold from Comex. I should have said Kyle Bass. There is a dollar shortage, and it doesn't matter. Currently, there is a dollar shortage, at least in the quantity of Federal Reserve notes. For the week ending September 25th, 2015, there were an estimated 1,384 trillion in Federal Reserve notes in circulation. The Federal Reserve's estimate that 2/3 of US currency is held overseas. While there is about 1.4 trillion in US currency in physical form, of which less than 500 billion is estimated to be in circulation in the United States, most of which is not at banks waiting for depositors to withdraw it, there are about $10 trillion in US banks deposits and 20 trillion held in US stock accounts. This highlights that there doesn't exist in physical form nearly enough unbacked paper dollars to cover the amount held in bank deposits. If just a small percentage of US citizens wanted to convert their bank account deposits or dollar-denominated assets into physical dollars, there wouldn't be nearly enough. During the current and ongoing physical dollar shortage, there's been no run on the banks. As long as people have faith in a fractional reserve system, a shortage in the underlying commodity or asset can be ignored as long as the value of that commodity or asset can be recognized by alternative means. A physical shortage only matters if the underlying asset is required to satisfy an immediate need or use. In such a case, the price of the underlying asset will certainly rise in price relative to its everyday fractional reserve price. For example, if the electronic banking system were to fail, demand for physical cash and its value would skyrocket. Or if there was a physical shortage of silver required for an electronics manufacturer to complete a batch of iPhones, the price of physical silver would immediately increase over the Comex trading price, and the Comex price would eventually adjust to a higher physical price, as the electronics manufacturer would pay a market price based on the actual amount of physical silver required to complete the order. People can suspend belief and convince themselves it doesn't matter that there is not a one-to-one correspondence in the physical amounts of gold and silver underlying their Comex contracts, until it does. Changes in the silver supply-demand dynamic of shortage nature described above would occur outside of Comex and would have the effect of wresting the price mechanism from Comex trading temporarily. You don't beat the casino at the casino. Point 3. Commodity exchanges, like casinos, have rules in place to ensure the profitable and continued existences of their respective businesses. What if faith is lost? Higher prices solve lower registered inventory issues. If indeed traders on Comex became nervous about the very low levels of gold and silver registered and available for delivery, most likely the price of gold and silver Comex contracts would rise, and more of the eligible gold and silver would be registered for sale at the higher price. The higher prices would satisfy the traders, and traders wishing to take delivery would be accommodated by willing sellers moving their eligible gold and silver into the registered category. If prices don't rise high enough to convince holders of eligible silver and gold to move their inventory to the registered category, Comex has rules on position limits that would serve to prevent the system from being overwhelmed. In a fast-moving market, however, position limits may not work. Traders, sensing an untenable circumstance and an actual physical shortage of silver or gold, may wish to take delivery in order to possess the physical commodity that will certainly rise in value, as confidence in the fractional reserve system is lost. Given that currently it seems that the Comex registered gold vaults are nearly empty, why hasn't a trader or group of traders stood for delivery? Analyst David Kranzler of Investment Research Dynamics took a crack at it. The simple reason, quote, the government would step in and prevent the trade from occurring to completion, unquote. Any such trader will certainly be shut down. The lesson of the Hunt brothers is instructive. Once it appeared that the Hunt brothers were becoming successful in gobbling up much of the world's available silver in early 1980, some of it by taking delivery on Comex. Comex limited trading in silver to liquidation orders only, with only liquidations sell orders going through. The price of silver dropped, and with it the value of the Hunt brothers' margin collateral, eventually resulting in a margin call the Hunt brothers couldn't meet, resulting in their bankruptcy. Lesson: you don't beat the casino at the casino. At gambling casinos, counting cards in the game of blackjack or 21 is not allowed, meaning if you found a way to beat the casinos, they won't let you do it. Indeed, this scene from Martin Scorsese's movie Casino illustrates what happens to people when they try to beat the casino at the casino. CME Rule 413. Comex is prepared for traders who may wish to beat the casino with either malicious or profitable intent. The CME Group, which owns and operates Comex, has instituted Rule 413 that provides, in relevant part, the Chief Regulatory Officer or his delegate, upon a good faith determination that there are substantial reasons to believe that such immediate action is necessary to protect the best interests of the exchange, may order that 1. Any party be denied access to any or all CME Group markets. 2. Any party be denied access to the Globex platform. 3. Any party be denied access to any other electronic trading or clearing platform owned or controlled by CME Group. Or 4. Any member be immediately removed from any trading floor owned or controlled by CME Group. Comex is prepared to shut down any trader or group of traders, irrespective of the trader's motive, if such trader or traders engage in a trade or series of trades that might not be in the best interest of Comex. So if a trader or traders standing for delivery might indeed cause a default of Comex, that trader or traders can be tossed from the system. A trader so exiled from the Comex trading platform can appeal his ejection within 10 days. Under Rule 413D, a trader's access to the Comex system can be denied no more than 60 days unless the Chief Regulatory Officer or his delegate, upon further consideration of the circumstances that resulted in a prior access denial action, provides written notice to the party that his access will be denied for an additional period of time not to exceed 60 days. Thus, CME Rule 413D gives Comex the ability to remove traders that may wish to institute trades that are not in the best interest of Comex. And 4. Comex is a US government-protected exchange. Assume a trader or group of traders stand for delivery that cannot be met, and they are not satisfied by a higher cash payment, and Comex fails to invoke Rule 413, in order to eject such traders to prevent the best interests of Comex from being harmed. Certainly, wouldn't it be game over for Comex? Probably not. Enter the Plunge protection team. After the stock market crash of 1987, President Reagan signed an executive order establishing the President's Working Group on Financial Markets. The task of this group, also known as the Plunge Protection Team, PPT, is to enhance the integrity, efficiency, orderliness, and competitiveness of our nation's financial markets and maintain investor confidence. The working group of the PPT is comprised of Secretary of the Treasury, the Chairman of the Board of Governors of the Federal Reserve System, the Chairman of the Securities and Exchange Commission, and the Chairman of the Commodity Futures Trading Commission. The working group has broad discretion to intervene in markets and, quote, shall consult as appropriate with representatives of the various exchanges, clearinghouses, self-regulatory bodies, and with major market participants to determine private sector solutions wherever possible, unquote. The United States government is the most powerful government on earth, and the members of the President's Working Group on Financial Markets are comprised of the heads of the most powerful departments in it. When it comes to protecting the United States financial markets and the dollar, messing with the US government is no laughing matter. It appears that the PPT is reluctant to allow the US stock market to fall even a few percentage points without intervention. Do you think the PPT is going to allow an important commodity exchange like Comex to default because a trader stood for delivery? One could imagine that any traders attempting to execute a trade that might cause harm to Comex would be dealt with harshly by the PPT in a number of ways. The trader's account could be suspended, his trades cancelled, his personal and business accounts audited by the IRS, and he would probably be fined, arrested, and charged personally as a terrorist. Do I feel lucky? To the intrepid trader who wants to stand for delivery of the last 160,000 ounces of registered gold in the Comex vaults, and in the process takes on the most powerful government in the world as well, you have to ask yourself a question. Do I feel lucky? End of article. So, there we have it. Today's position on the Comex appears similar to that as in 2015. However, in a previous video, we've also pointed out that the Comex are allowing different sized gold bars to be allowable for traders in order to overcome a shortage in the traditional 100-ounce bars. But as we've already stated, even if they were to run out of those, there are sufficient mechanisms in place to prevent the Comex from going under. Now we wish to conclude this video with an important message. We are not saying by any means that what is going on in the world today and the financial crisis that many businesses will now be suffering moving forward will not lead to the rise in the price of gold and then to silver as it becomes, or they become, the safe haven for investors. What we are saying, though, is to put all of this into perspective. If gold does rise back to its all-time highs of $1,900, it will have performed very well. And if it hits $2,000 this year, which we doubt, but it is a possibility, it will have performed extremely well. But look at the fundamentals. Look at the economy when making your decision whether to buy gold or silver or not. But whatever you do, for your own financial prosperity, do not be suckered in to Comex going bust or US dollar crashing as the motive behind your purchases. Because if you do, unless it's for hedging purposes, even in this uncertain environment, it is our opinion and experienced assessment that you could rue that day, especially if there is short-term panic, causing prices to temporarily rise as these stories gain traction. However, it goes without saying that if you already hold plenty of gold and silver, and you are waiting for such an event to occur in order to sell it, then that's another matter. Thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. Not forgetting that we update our Richard and Greg channel every other day, though we did put up an additional video on that yesterday. And again, if you haven't done so, please subscribe to that one too. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.